Today, we are talking about how can property investment help in planning for a superior retirement. I'm here with OpenCorp Group CEO, Matt Lewison. Really great to see you.
Thanks, boys.
So I guess to kick off, when we think about retirement planning, it's, used to be pretty much shares, property or Tats Lotto with the different strategies that you could employ. Probably throw Bitcoin in the Tats Lotto bucket. So if we kind of think about shares versus property and as the main, reliable vehicles for people to grow their wealth, to improve their retirement, what are the key things that people need to understand? And I guess what's the bigger picture that's not always communicated when it comes to these two different asset classes?
Yeah, I guess people often talk about the fact that shares and property over the last 30 years have pretty closely mirrored each other in terms of total returns. Residential property has outperformed shares, but I wouldn't say that on an index basis it's overly it's smashed shares out of the park. And that's where I think a lot of people's proponents for shares in particular start to really draw on that. They say, well, shares might be better because it produces a higher income, whatever it might be. But what they fail to really grasp is that there's a huge difference between shares and property in terms of the leverage that you can employ or use it for your benefit. And if I kind of use my dad as a quick example, he's retired in his late 60s now. He's been retired for some time, but he has about 50% of his portfolio today is shares, 50% property. He loves the shares because he likes to trade them and he loves talking about what he bought and all the good deals that he got, and he never talks about the ones that lost. Like all my mates who go to the races and never tell you how much they lost to the bookies. But if you go back 10 years ago, his portfolio was 90% property, 10% shares. And if you go back 20 years ago, it was 100% property. And that hasn't changed because he suddenly realized shares are better than property and I did the wrong thing. What's happened is that he used and he understood really early the benefits of leverage. And he used leverage to his advantage through his 30s, 40s, and 50s by buying property and growing his portfolio of property. And then as he cleared his debt and transitioned to retirement, he started selling off some of his properties. And now he sits surplus cash either in the bank or he's using it to buy shares because it has different liquidity mechanisms for him. And he still likes to own property, and he certainly wouldn't be in the position he's in now if he had have just gone straight for shares, because it would have been a very tough grind and got nowhere near his level of wealth if he was just relying on his savings going into buying more shares and reinvesting those dividends, as opposed to borrowing 80% of a property's value and having that go up with the market price. So they're obviously, I don't like people to think that that we're anti-shares at all. We certainly see that shares have a place in people's portfolios at different times and for different reasons. But for somebody trying to grow their wealth and get into a position to be able to retire, property absolutely smashes shares every day of the week.
Awesome. Great insight. So given that we might have some rookie investors on as listeners, let's use some really round numbers to illustrate what you've just said there. So if I said to you, hey Matt, you can get a 10% per annum return with property, or you can get a 12% per annum return with shares, then Joe or Joanne Public's going to say, I'll invest in the shares because the return's high. Right? But leverage being the fact that you can actually put in your money, but borrow a large chunk of in this case, the property value, gives you a much larger asset base on which to get that 10% growth, right? So really round numbers. I know they're not perfect, just to illustrate the topic here and keep it simple. Let's say that you had 100,000 to invest, and you put that 100,000 into buying a property. You could probably borrow the other 500,000 quite easily and have a $600,000 property or thereabouts. Now, that growing at 10% per annum means that in year one, your wealth has increased by 60K. On the flip side, if you invest that $100,000 in the share market, because there's, while you can get leverage in the share market, it comes with much higher risk and much higher exposure that most people, apart from professional investors aren't comfortable with. If you just invest that 100,000 and you get 12% growth on that, then you've made $12,000. So in year one alone, you're 5 times better off investing in property than shares. Yeah. So hopefully that helps everyone. Now, you talked about your dad and the fact that he's now retired. There may well be some people out there in their late 40s, early 50s, thinking, oh, have I left it too late to get started? That's something that we hear a lot talking to our clients, as you know. We've had a really good case study of investors who came across us, started working with us 10 years ago, and retired last year. So they started in their early 50s. So maybe just talk to the point around why, if you've got a 10-year horizon, that's plenty of time to build a property portfolio.
Yeah. Look, I think one of the key things to start with is that what I have also seen personally is that as people approach retirement, if they're not in a position to retire, they can start to take larger risks because they think my window just to make a big difference is shrinking. And so they start to invest in places that they probably wouldn't have. Now, that the key thing here, and I guess people who perhaps don't realize, is that residential property has been a really solid performer. It's actually been the least volatile investment class in Australia when you compare shares, managed trusts, and so on. Property has very low volatility, has very few negative years, essentially.
So you sleep a lot better.
So depending on the strategy that you employ in residential property, it can be a lower risk than other types of investments. And you don't need 20, 30 years. Obviously, the longer you have, the better. But certainly if you use the right strategy and you're investing in property and you're able to start and aim to buy 2 to 3 properties in that 10-year period, then you can have a huge impact on the total outcome. Again, if you're starting with just a couple of $100,000, but you've got enough income, people in their 50s are actually generally earning a lot more than people in their 20s and 30s. They're often also got kids who have moved out. So the financial burden starts to diminish, which frees up for a really short window of time this extra capacity to fund into investments. So focusing in that over 5 years to buy a couple of properties and then sit on those properties for the next 5 years can make more than $1 million difference to the retirement savings. And that doesn't require a huge amount of return. You don't need to be taking huge risks to get properties that will go up. Even if it's 5 to 7% per year in capital growth, if you own 3 properties and let's call that $2 million worth of property that you're holding, going up 7%, that's $140,000 a year. Do that for 5 years, suddenly you're at $700,000 extra equity just in that 5-year window. So it's not that hard once you kind of break it down and you put the steps in place. But again, the earlier you start, once you realize that you kind of have this ground to make up, the better off you would be, and the less you will feel like you need to engage in some of the riskier strategies of property investment, flipping or development, and other aspects that could expose that capital to risk.
So a bit of well thought out planning avoids the need to kind of play rapid, catch up, and get rich quick, which, as we know, generally means lose money fast, or at least in the OpenCorp language it does. So that leads into a good question, I guess. When should people start considering this? Because I guarantee, if you're listening to this and when you heard me say retirement at the start of the conversation, you probably thought, I don't need to worry about that because that's miles in the future. You've just talked about the power of time. When should people start thinking about these things and be considering how they can improve their situation?
Oh, look, I think there's every person can be thinking about, from the age of 18, 20, how to improve their life, right? We all aspire to have a better life tomorrow than we had today or in the past. Obviously, the closer you get to retirement, the less window of time you're going to have for your income to support your investment goals. But it's something that, other than perhaps in that small window of time where people In fact, even then, when people have just started having children and they're, you've got to start to juggle different things. I mean, we still see people successfully growing investment portfolios then. So I think as soon as you realize that what you've been doing in the past hasn't achieved what you wanted it to achieve or what you want in the future, you absolutely need to start taking steps to make changes. And that can start by educating yourself to know what you need to have and what you need to put in place to be able to take positive steps forward.
So true. My wife Beck and I were just talking on the weekend. So our eldest's 11 in a couple of months, and we were just talking about how we were doing his birthday party invitation. We were talking about how quickly 11 years has gone, and we were able to, or decided to, buy a property right before he was born because our servicing was better, and obviously kids impact your borrowing capacity. And so I just looked up, the value of that property that we bought, and it's pushing 800,000 now. And Beck said, "Oh, what did we buy it for?" I said, "Well, I remember it was 397,500 because it was under 400k." Yeah, and at the time I went, "Oh, property's nearly 400,000." I'm like, "Guys, it's really got a lot more expensive than I bought the first one for 267,000." But our kind of kids are more than 10 years old. Time's flown, but that's the kind of thing that can happen with one property, let alone multiple. So I think it's a really good lesson that you're leaving for people there. Get started as soon as you can because time flies, and stay focused. So when you can add to your portfolio, do so, because I think one of the big misconceptions out there is that you need a massive portfolio to be successful, which we know you don't. What was that book, like 0 to 130 properties in 2 weeks or whatever it was called? And that was based on a completely different strategy where you needed that. But as soon as prices grew and deposit requirements increased, it just wasn't a strategy that was feasible. So, it's I guess it's important for people to realize that you don't need a massive portfolio, you just need something that works.
Yeah, spot on. And look, for people who are in their, let's call it late 40s and in their 50s, what somebody can do in their 20s or 30s, growing a portfolio of 3 to 4 properties on a pretty modest income, as most of us have, like coming through 20s and 30s. Somebody in their 40s and 50s can do in a much shorter space of time. And we've seen it time and time again because of that extra servicing capacity and extra savings or equity that you've already built up in your own home. It surprises people once they really understand the strategy, how easy it is for them to grow their wealth in a really short space of time without taking on a lot of risk.
Well, that was Mark and Sue's success recipe, wasn't it? Coming to us in their early 50s, and because they had equity in their home and they had double income with kids that weren't all dependent, and they followed the plan where it was they bought 2 to start with and then 1 every year for the next 3 years. In 4 years, they had these 5 properties, and fast forward to year 10, it's created an amazing outcome for them that they just wouldn't have got through super or shares. So I guess if we think about the alternative, right, because there'll be people out there that are thinking property investment risky, I haven't done it before, it's scary, all of those things which are valid emotions to feel. It's very easy to overcome those, I guess, like it is with anything, having a coach and people that can support you. But I've often talked to people about being aware of the alternative, and that's far more scary. So, what does that look like? What are the kind of factors that people need to consider, and what does the retirement look like if they don't have a solid retirement plan that factors in inflation and they are relying on the pension?
Well, as I said earlier, as people approach retirement, there is a propensity to take greater and greater risk if somebody's not comfortable with what they've got and kind of are staring down the barrel of a less than comfortable retirement. And decisions that are forced upon people as well to live perhaps in places that are much worse than where they've lived perhaps previously. And it's really taking significant steps backwards in terms of lifestyle at a time when you should really be enjoying your life and getting the benefit of the hard work. that you've put in over the years. Now, obviously, the big difference between somebody who's got a comfortable retirement and somebody who doesn't often comes down to the decisions that were made along the way, not necessarily how hard they worked, but the decisions they made, and the investments that they made along the way, whether that was to start investing early or start educating themselves about investing and then be in a position to invest. So I think, look, I'm actually, to use a personal story, and I had somebody house sitting my house recently who is retired and friend of a family member. He doesn't have anywhere else to live, so he's kind of been house sitting in his 60s, house sitting for friends and friends of friends, and otherwise living with his kids, and a great income along the way. Just different decisions that were made led to him not being in a position to, I guess, fund his own retirement at the end. And I think it's something that if people sometimes put off thinking about their retirement because it is scary, and you don't want to think about something that stresses you out or worries you. But again, I just say it doesn't take that much thought to take the right step, to put one step forward towards getting a little bit of education, and there's businesses that can obviously help. So one step forward to speak to somebody who knows what they're doing, who can help you take those steps beyond that first step, so that you can really look forward to a more comfortable retirement. You don't have to stop avoiding the thought of it, and even start looking forward to it and enjoying it.
It's really about thriving, not surviving, right?
Yeah.
And I think about the two main income sources that people talk about in retirement are the pension and super. And the pension, just even thinking about it kind of makes you want to put yourself in denial and go, I can't handle that, because at the last check, a comfortable pension for a single was in the vicinity of $35,000 a year, for a couple at $60,000. I'd hate to think what life looked like when you're supposed to be thriving and traveling and rewarding yourself for, the first kind of 50 or 60 years of your life that you've worked really hard to then have to diminish your lifestyle so significantly because the available cash flow is just so much less than what you're used to. That's a good enough motivator to be doing something else and investing, in my view. And with super, you'd see all those industry super ads, and especially the ones with the people on the lift versus someone else. And I could never understand, like, the best case scenario they were talking about was someone that had around 250,000 in their super come retirement age. Now, that might sound like a big number, $250,000, but when we've had inflation where we've had it, and the fact that the value of cash is being eroded at a rapid rate, and the fact that if you do some simple numbers and say you take 5% of your super every year, 5% of 250,000, round numbers 13,000. Hardly anything that's going to be creating an amazing lifestyle in retirement. So let's say that you switched on, let's say that you make some good decisions, and let's say that you've given yourself some time of 10 years or more to create an amazing set of carefree moments or retirement, whatever that might mean to you. What happens when you decide to retire as a property investor? So you've talked about how your dad shifted in terms of asset classes. What are the other options that are available as exit strategies?
Yeah, so look, I think the first one that comes to mind is living off income. And again, in retirement, for most people, the easiest terms to put in is income, not a lump sum. I mean, it sounds nice. The 250 Rand, as I said, can sound like a big number to some people, but what does it mean in terms of income? What does $1 million mean in terms of income? What does, that total number is really driven by what you need every year to be able to live the life you want. Going on holidays if you want to go on holidays, supporting your family, ensuring you're getting good care if you need health support. So to transition to getting that income, I mean, part of it is either you build a portfolio of properties and you ensure that your income is far exceeding the debt, in which case, or your servicing of interest costs, and the surplus that you're getting is income that you receive, and that should grow over time as rents go up over time and your interest cost goes down as debt might be paid off. So that's one option. Now that does require a very, very early start or a larger portfolio to have a meaningful impact. Now, if you talk, let's call $500 a week being kind of a reasonably, like a rent that you could assume you'd be able to achieve in most places around Australia right now if you owned a property outright. That's $25,000 a year before costs. Let's take that down to $20,000 after you've covered rates and all that sort of stuff. So one property with no debt is $20,000 a year. Two properties with no debt is $40,000 a year, and so on. An alternative way of looking at it is that you have 4 properties with debt could be the same as 2 properties without debt. So there's different ways to kind of manage that. And again, it depends on what your income is during the growth phase and kind of what your plan is afterwards, what other savings you have. Then there is also, I guess, what we would call more of a transition to retirement, which would be selling off some properties. If you've built up 4 or 5 properties in your portfolio, you held those for 5 to 10 years. So the value continues to go up and the debt stays stable or goes down. Then you're in a position that if you sold 1 or 2 properties, you can often clear your debt, and then you own maybe 3 properties, debt-free, and you can live off that sort of $70,000 or $60,000 a year, but growing in that income indefinitely. And so the goal would be to kind of sit on those properties for as long as you need, and you can, if you need extra cash one year, you can sell one of those, and you obviously have a very big cash bucket after that. What we kind of tend to see, and what I really advocate for, is more of what's called the domino effect, which is what my dad used and something that I modeled for him when he was going through this process about 13 years ago to work out what does his retirement look like and how does he shift his big asset base to something he can live off, because he also did have a fair bit of debt still. And the domino effect looked more like using surplus income for a short period of time to pay down the debt on one of the investment properties. Now, as that debt reduces, the surplus cash flow increases because there's less interest cost and the rents stay stable or go up. So it took a couple of years to pay off that first property for him, but then second was a lot faster because now he had an extra kind of $20,000 of cash flow going towards it. And after the second, the third, and then the fourth, it kind of snowballed until the point where he had no debt left in his portfolio. Now that kind of, again, comes back to the fact that he had a really solid income in his 50s, and he was able to do that a lot faster than somebody in their 40s could do, or somebody in their 30s. So again, it's understanding the life cycle of a property investor, to understand there's different times when certain strategies are going to work better for you than others, and it's not one size fits all, because that strategy wouldn't necessarily work for somebody else who had different circumstances. They're kind of the main ones that I always come to. I know there is also living off equity, which is kind of using the growth in your asset base and kind of redrawing to access some of that value through increasing your debt. That's become less prevalent in recent years, just as obviously lending restrictions or lending conditions have changed, and also people's propensity to want to have debt going into retirement changes as well. So they're kind of the 4 main ones that come to mind for me, but I missed any?
No. All I was going to say was, and it's very individual, as you say, but depending on the exit strategy that you choose at various points, it might be a little bit from part A and a bit from part B. It might not be, and one particular exit strategy that you have to determine at the start and commit to at the end. It is flexible and fluid, And that's where, while we talk about property being a long-term investment, if you can keep your finger on the pulse and be consistently reviewing where things are at in line with the goals that you've got, then you can make sure that the portfolio is working as effectively for you as you can, and you're just being agile. I think the Cam talks about it a lot, and we talk about it a lot as well, that I think a lot of people, when they start out, think because properties are we're always told properties are long-term investment. So it's almost like buy it, set and forget, and then click your fingers, and in 20 years it will have worked for you, which is true, but you actually start to create wealth, at a very rapid rate. We've got clients that are 150,000 up in about 18 months in terms of growth. The rent is $200 a week more than what they were budgeting on. There's an instant increase in wealth effect that happens in the short term, where they start to get some positive reinforcement around these decisions that they've made.
Yeah.
It's not like you've got to wait 20 years to kind of see the fruits of your labour. So
100%.
Yeah.
I guess one other thing, just as I talk about kind of preparing for retirement, there's been a few cases where people that I know we've been mentoring, coaching, and they've started talking about selling off some properties as they kind of approached retirement. And ultimately, what they ended up doing, which put them hundreds of thousands of dollars ahead, because they were in a great position to be able to duplicate, but they were thinking about, I want to pay off this debt. They ended up buying an extra property, and within 3 to 4 years, like having bought in the right capital city location, the quarter rising kind of market, then they were able to sell off that property, having made a couple of $100,000 on not just the one that they bought, but the one that they would have sold as well. And they were able to reduce their debt a lot faster. So again, it can act counterintuitive to perhaps how people might consider the best approach if they haven't been through it and they're not kind of an expert who studies the market and understands, kind of having seen hundreds of people go through an exit and planning for retirement, what has and hasn't worked. So there's a lot of different things. And again, it just comes back to the need to have a plan, to be well informed, and make sure that you only get one shot at it often in terms of that transition to retirement. So putting your best foot forward.
Awesome. That was a great summary. Look, hopefully that's been helpful for everyone to start thinking about retirement planning, whether that be for your actual retirement or just being able to have a bit more choice in life around what you do and improving your lifestyle with a lower reliance on the income that you Monday to Friday 9 to 5, and the need to be working full time perhaps. So absolutely, understand your options, understand leverage, get your property selection right, give yourself plenty of time, avoid the pension at all costs because it's not going to be a fantastic outcome, and you've got a number of exit strategies that are available to you to ensure that you can start to enjoy the fruits of your labour sooner rather than later as well. Matt, thanks for joining us.
Thanks, boys.